Hello everyone. I will cover chapter 10 in this lecture. This chapter is about fixed income securities, and these are the concepts that we will cover in this lecture. So we start with the basic idea about bonds. So bonds are publicly traded long-term debt securities. So they provide regular income in the form of interest payments at fixed rates. And you also get the principal payment at maturity. Because the interest payments happen at fixed interest rate, it is called fixed income securities. The bonds provide two types of income. One is current income in the form of interest payments, and capital gains in the form of variation in bond prices. So we look at the bond prices. So bond prices depend on interest rates in a significant manner. So when the prevailing interest rates rise, we notice that bond prices fall. The existing bond ends up offering less interest rate than the prevailing market interest rates. So investors do not want to invest in existing bonds. They want to invest in new bonds which offer higher interest rate. The demand for existing bonds fall and their prices also decline. When interest rates drop, the prevailing interest rate is less than what existing bonds offer. So investors would want to buy the existing bonds and earn higher interest. This drives up the demand of existing bonds and their prices go up. The bonds are generally issued by corporate entities as well as government entities. Corporate bonds are considered more risky and hence they pay higher interest to compensate for the risk. The difference between corporate and government bond rates is called the yield spread or credit spread. So we look at the yield for US Treasury bonds, which are government bonds, versus corporate bonds. Now we look at the historical trends in bond returns. So total return means capital gains as well as the interest income. So the total returns depends on the direction of interest rates. If the interest rates are rising, the capital losses from the bond prices may be more than the interest payments. So it leads to a net loss and net negative total return. So these are the total return from treasury bonds in different years. So we notice that bond prices have an inverse relationship interest rates. So whenever interest rates fall, it leads to significant capital gains, and that drives up the total returns from bonds. So whenever bond yields have fallen, it generally leads to significant total returns from bonds. How does bond compare with respect to stock? So they generally offer lower returns, but they also have lower risk and higher levels of current income because interest payments are more certain as compared to dividend payments. And bonds also offer significant diversification in our portfolio of investments. So here we compare the value of the stock index, S&P 500 stock index versus the bond market index. And we generally see that the stock market outperforms the bond, but the bond market index is more stable and has less fluctuations, both on the positive and negatives. So what are some of the risk in bonds? The first is interest rate risk. So changes in interest rate may negatively affect the bond price, especially when interest rate goes up, the bond price goes down. There is the inflation risk, that is, the bond yields may be less than inflation rates. So the inflation erodes the purchasing power of the investment. The issuer of the bond may default, which may be due to business and financial risk. Liquidity risk is the inability or difficulty in selling the bond at a reasonable price. So there may not be a good market for trading the bonds. And call risk is the risk of the bond being retired before its maturity date. That is, the issuer repays all outstanding obligations before the maturity. Now we look at some of the essential features of a bond, things like interest, principal, and other important concepts. So bond is basically a long-term debt instrument. The issuer or the borrower has to make regular interest payments and principal payments to the bondholder or the investor. So what is coupon? Coupon is the annual interest income for the bondholder. Principal is the amount that the bondholder will receive at maturity. It is also called the par value. Coupon rate is the coupon divided by the bond's par value. So it expresses the interest rate in percentage term. Current yield is the bond's coupon divided by the bond's current market price. So coupon rate is coupon divided by par value, and current yield is coupon divided by the bond's current market price. Maturity date is the date at which the principal will be repaid. So it's a fixed date, and whatever time remains till maturity is called the term to maturity. Term bond means the bond has a single maturity date. The entire amount of the bond will have a single maturity. Serial bond means the bond consists of a series of bond with different maturity dates. So it's like staggered maturity instead of single maturity date. And a note is a debt security which is of maturity ranging from 2 to 10 years. And bonds are debt securities which have maturity more than 10 years. So the prevailing interest rates have an impact on the bond prices. If the bond price is more than its par value, then we say it is a premium bond. And if the prevailing interest rate is less than the coupon rate, or rather the prevailing interest rate is higher than the coupon rate, then the bond is selling at a price less than its par value. So it is called discount. And we notice that the higher the maturity of the bond, it is more affected by the changes in interest rate. That is, the price volatility of longer maturity bonds is more. So this shows how different interest rates have an impact on the price of the bond. And if you notice, the price fluctuation is more as the maturity increases. It increases from 0 to. So how are bond prices quoted? For corporate and municipal bonds, it is quoted in decimals. And for US Treasury as well as federal agency bonds, it is quoted as a fraction of 32. So what is a call feature? Call feature means the bond can be repaid before its maturity. So the bond is retired before its maturity by paying off all outstanding obligations, interest as well as principal. So the bonds can be freely callable, which means the issuer can prematurely retire the bond by paying off all obligations, and they can do it at any time. Non-callable means the issuer cannot prematurely retire the bond. Deferred call means the issuer can retire the bond, but they can only do it after some time has passed from the issue date. So call features is beneficial for the issuer. If interest rates decline, they can retire the current bond and issue new bonds at a lower interest rate. Similarly, it is a loss for the investor. They may get back their interest. They may be repaid their interest and principal early, but they now have to invest that amount at lower interest. So what is call premium? Call premium is the additional amount added to the bond's par value in order to compensate bondholders against early retirement of the bond. Call price is the bond's par value plus the call premium. And the bonds may also have refunding protection. So this is a condition which prohibits borrowers from issuing a new lower interest bond and using the funds to repay an outstanding bond of higher interest. So the issuer has to secure funds from other sources and not by issuing a new bond of lower interest. This provides some protection from easy call by the issuer. Sinking fund means it's a provision on how the issuer will pay off the bond. It applies for term bonds because they generally have a single maturity. So sinking fund means some part of the bond will be repaid before the actual maturity date. The bonds can be secured or unsecured. Secured bonds means they have some asset or property attached to the bond. So in case of default or failure to repay, the bond holders have access to the property or asset provided as security. So they can dispose that security and recollect some of the payment obligations. So mortgage bonds means they are secured by real estate. The real estate property is a security against the bond issued to investors. Collateral trust bond means they are financial assets of the issuer which is held in a third party trust. So that acts as a security or collateral for the bond. Equipment trust certificate means specific pieces of equipment such as airplanes, railroad engines. Those are used as security for the bond. First and refunding one, it's a combination of first mortgage and junior mortgage. So first mortgage means, so in this case, the bonds have the first mortgage claim on some property, and it has secondary, that is second or third mortgage claim on other properties. So it is a combination of some primary security versus secondary claim on security. That is why it is less secure. For other bonds, the bond holders have primary claim on the security. In this case, the bond holders have primary claim on some security and they have secondary claim on other security. Secondary claim with respect to other investors in other bonds. Junior bonds, these are unsecured. They have no collateral or security attached to them. The debenture is generally unsecured, and the only assurance is the credibility of the bond issuer. Subordinated debenture means these are also unsecured bonds, but they are secondary to other debenture bonds. So we have secured bonds, Then we have debentures. And below that is subordinate debenture. So first, secured bonds will be paid off in case of any default or failure to repay. Then the debentures will be paid off with whatever is remaining, and then subordinate debenture. And then we have income bonds. So these are even secondary to the subordinated debenture. So in this case, the issuer will pay interest only after they have achieved a certain amount of income. Now we discuss about bond rating. So bond ratings are a measure of the credit risk or the risk of default by the issuer. So bond ratings are issued by uh, specialist organizations, and they assign grades to different bonds, which corresponds to a certain level of credit risk of the issuer. So how do ratings work? The rating agencies look at the issuer's financial strength. They look at how much debt the issuer has assumed, how what is the position of their cash flow, and so on. Higher ratings mean the company is in a better financial position and is less likely to default in its payment obligation. So based on the ratings, we have investment grade bonds. So these are bonds which receive one of the top 4 investment ratings, which shows that the bond issuer is financially strong. Junk bond means the bond has received below investment grade rating. It means that the issuer has some concerns about their own financial strength. Split rating means a bond has received different ratings from different agencies. The bond rating does not remain constant, rather, it can change over the term of the bond based on the financial condition of the issuer. Bond ratings may improve or it may decline. So these are the bond ratings provided by leading bond rating agencies. The top 4 are investment grade. Below that is the junk bond ratings. So what are the implications for bond ratings? Higher rating means lower yield. Higher rating means the investors demand lower interest rate from the issuer. Also, the bond rating has an impact on how sensitive is the price of the bond. If it is a junk bond, then it is more sensitive to interest rate movements or changes in the company's financial performance. So any good change or any negative change has more impact on the price of junk bonds. The purpose of bond rating is to save time and resources for individual investors in trying to do an credit analysis and figuring out the credit risk of bonds. So that's all for this lecture. I will continue with rest of the chapter in the next lecture. Thank you.